Bombs dropping, yields ripping, and the tape's got more casualties than a Wusta dive bar on a Saturday night. Welcome home, trading family. Wildcard here with TB. It's Thursday, July 30th. And if you're still standing after yesterday, you've earned your stripes.
Before we dig into the wreckage, quick reminder, nothing we say here is financial advice. We're two traders talking markets. Do your own homework, know your own risk, and never trade money you can't lose.
The tape this morning. Dow futures trying to stabilize after yesterday's 1,100-point rout. The S&P and Nasdaq holding on by their fingernails. The VIX is elevated, not panic spiking, but not backing down either.
Overnight setup is mixed. KOSPI down another 1.2%, Korea still bleeding from the chip unwind. Europe muted, digesting the Fed fallout. The dollar index flat, dollar yen steady. The carry trade isn't flashing red today, but it's not calm either.
Here's the tension, and it's a big one. 30-year Treasury at 5.2%, highest since 2007. The Fed held yesterday with three dissenters who wanted to hike. Apple and Amazon report tonight, PCE tomorrow, and a Russian missile landed near the Polish border at 3:40 in the morning local time. You want to stack tape? This is it.
Let's start with the number that matters most. 5.2% on the 30-year Treasury. That's the highest yield since 2007. And this isn't a tantrum. This is structural. The Fed held rates at 3.75% yesterday. 3 Federal Open Market Committee members dissented and wanted a hike. That's a big deal. Committees like the Federal Open Market Committee don't show cracks like that unless there's real disagreement about where rates need to go. But here's the thing. The bond market didn't wait for the vote. It's already doing the tightening. A 5.2% 30-year means mortgages are getting crushed, corporate debt is repricing, and every consumer with a credit card is feeling the squeeze through the curve. The Fed held short rates, but long rates are pulling the economy into a vice. And this is the part nobody in Washington wants to say out loud. The United States is financing a war while running trillion-dollar deficits. And the bond market is demanding a higher term premium for taking 30-year credit risk in that environment. That's not a political statement, it's math. Higher deficits plus geopolitical uncertainty equals higher long yields.
Say it again for the people in the back. The bond market is doing the Fed's job, while the Fed sits there with three dissenters and a press conference full of watchful thinking. Watchful thinking. Not watchful waiting, not watchful hiking. Watchful thinking. That's a committee with no good options. And here's where it gets dangerous, TB. The Fed can't hike into an oil supply shock driven by Iran and now Poland. They'd kill the economy on purpose, but they can't cut either, because inflation is still above target, and a cut into this environment would send the long end even higher. The bond market would read it as surrender. The Fed is boxed in.
That's the stagflation box, and it's exactly where the bond market has them pinned. When the 30-year reprices like this, the transmission mechanism is brutal. Mortgage rates follow the long end. Anyone who locked in a 3% mortgage in 21 is now looking at a 7% refi. That's a straight-up consumer spending drain. And on the corporate side, names that need to roll debt in the next 18 months are staring at a completely different cost of capital than they modeled 6 months ago.
You just teed up the blast radius perfectly. Let's talk about what this actually looks like on the ground, because the numbers from yesterday are staggering. The Dow dropped 1,100 points in a single session. Biggest one-day loss since April 25. The S&P lost 1.5%. The Qs dropped 2%, and that's the correction marker. The Nasdaq is now 10% off its high. But the headline indices don't tell the real story. Look at the sectors. Technology, ticker XLK, is down 7.6% in 1 week, 7.5% in 5 sessions. That's not a pullback, that's an evacuation. Meanwhile, healthcare, ticker XLV, is up 4.3%. Consumer staples, XLP, up 3.5%. Real estate, XLRE, up 2.1%. Money is fleeing anything that needs growth and cheap money, and piling into things people need regardless of what the economy does.
That's a full defensive rotation. When staples and healthcare lead while tech and discretionary crater, that's the market pricing in a slowdown, not just a dip. And the KOSPI, down another 1.23% overnight, is telling you this is global. Korea's got heavy chip exposure. SK Hynix, Samsung, and the sell-off started there before it hit Micron and Nvidia stateside.
Now here's the part that hurts. Mike Jones reported 360,000 margin accounts were liquidated in this shakeout, 62% of them under 35 years old. That's our crew, the retail army that's been grinding through this tape. They got levered up in a market that broke the wrong way, and the margin desk didn't send a warning shot. It's in a liquidation notice.
And that's the data point that matches what my system is showing. The Wave Trader algo has taken 0 entries in 4 sessions. 0. The signal funnel is rejecting everything because prospective gain is below 5% across the board. And exponential moving average alignment is broken on names that were working last month. CrowdStrike, Wolfspeed, FormFactor. The market environment is simply saying no. That's not my algo being broken. That's the macro rejecting every setup.
Same read from the TFT algo. $107,000 equity, $55,000 in cash. 2 positions. Apple and Bank of America. That's it. 0 new entries in 4 sessions. The algo isn't being cautious. It's reading the room. And the room says the risk premium is too high for anything to look good.
Which brings us to the next 24 hours. If Apple and Amazon guide weak tonight, the blast radius we just described is just the opening act.
Let's go there. Earnings. Tonight is the biggest doubleheader of the quarter. Apple, consensus, $1.88 a share. Amazon, consensus, $1.82.
But nobody is trading the print. What matters is guidance and what both CEOs say about artificial intelligence CapEx and the consumer. If Apple says China demand is weakening or Amazon says cloud growth is slowing, tech takes another leg lower, regardless of what the earnings number says. If they both guide strong and say the consumer is holding, we get a relief bounce because every fund manager is positioned for bad news right now.
The whisper is that artificial intelligence spending is still on track, but whispers don't pay your mortgage. We'll know by the after-hours tape. Nothing else notable on the earnings calendar this week, so we're not going to manufacture coverage. It's Apple and Amazon, period.
Now the economic calendar. Yesterday, the Fed held at 3.75, matched consensus. Tomorrow is the big one, core PCE price index. Consensus is 0.2% month over month, 3.3% year over year. Prior readings were 0.3 and 3.4.
If PCE prints hot, say 3.5 or higher, the 30-year goes to 5.5 and equities leg down again. If it prints cool, the bond market reprices and we get the relief rally that every beat-up tech trader is praying for.
Also on the Friday docket, German regional CPIs, German GDP with consensus of 0.1% quarter over quarter, Eurozone GDP, Eurozone unemployment at 6.2% consensus, and the Bank of England rate decision expected to hold at 3.75. All side dishes. PCE is the main course, and the German data matters only if it diverges sharply.
Let's hit the sector rotation one more time so the audience has the numbers burned in. 1 week performance. XLV Healthcare, plus 4.27%. XLP, Consumer Staples, plus 3.53%. XLR, E-Real Estate, plus 2.1%. Those are your leaders. Laggards. XLY Consumer Discretionary, minus 2.1%. XLU Utilities, minus 2.2%. And the big one, the tech sector, technology, minus 7.6%.
Pure risk off. Money is hiding in things people buy regardless of the economy, medicine, toothpaste, rent, and fleeing anything rate sensitive or growth dependent. If healthcare and staples start rolling over too, that's the next warning shot, because it means the defensive trade is getting crowded and people are moving to cash.
Now, let's connect the international dots. Asia overnight. Nikkei up 0.71%, Hang Seng up 0.2%, Shanghai down 0.23%. Korea, the standout loser, Kospi down 1.23%. Chip heavy, still bleeding.
Europe digesting, DAX down 0.1, FTC up 0.39, Eurostoxx 50 up 0.53. Muted. Nobody's making big bets ahead of PCE and the Poland situation. On the currency side, dollar-yen up 0.17%, euro-dollar flat, the dollar index up 0.06. Carry trade unwind risk is present but not screaming today.
Now here's the geopolitical wiring that nobody's connecting yet. Poland missile, 3:40 in the morning. Russian missile near the border. Prime Minister Tusk confirmed it. Poland is a NATO member. If they invoke Article 4 and request consultations, you're looking at a diplomatic escalation that changes the risk premium on everything. European defense names, energy stocks, and particularly oil.
That's the structural bid under the energy sector ETF trade. Energy stocks are getting bid not because demand is surging, but because supply disruption risk is being repriced. A NATO country on the edge of an active conflict zone changes the calculus for every barrel that crosses a border in Eastern Europe.
Which brings us to the portfolio hot news. And this is where the rubber meets the road. The hottest theme touching our book right now. Cash is a position. My TFT algo is sitting at $107,000 equity, $55,000 in cash. Two existing positions, Apple and Bank of America. Zero new entries in 4 sessions. The drivers are clear. Prospective gain below 5%. Exponential moving average alignment. Broken macro chaos filtering every setup. The bull case for sitting in cash is that patience preserves capital for when conditions clean up and the signal funnel starts firing again. The bear case is that staying out too long underperforms if we get a sharp V-bounce. But the algo's risk framework says no, full stop.
Same story on my side. WaveTrader Algo has 19 open slots and 0 entries in 4 sessions. The funnel is rejecting everything. I've got BYD long riding at $90.79 with an unrealized gain of $41. That's my only active position. Stop at $82. Letting it breathe because it's not breaking down, but I'm not adding a single share until the environment cleans up.
My gut call account, the Paper Feelings book, is long the energy sector, ETF, entered at $56.94, now at $58.65, stop at $54.30. The thesis is structural oil premium from supply disruption risk. Iran, now Poland, the whole geopolitical tinderbox. But here's the key. I'm not adding. I'm not sizing up into binary events. The trade is working. Let it work. Don't get greedy.
The bottom line for listeners, protecting capital when bombs are flying and yields are repricing is the trade. The 360,000 margin accounts that got liquidated are a warning. Don't force entries into an environment this chaotic. Cash is a position, and sitting on your hands is a discipline, not cowardice.
Here's what we're watching tomorrow. 4 concrete things. Number 1. Core PCE year over year. Consensus is 3.3%. Hot or cold sets the entire bond and equity tone. Number 2. Apple and Amazon after-hours reaction. Watching the after-hours tape for the market's reaction to their earnings. Number 3. The 30-year Treasury yield. Holding above 5.2 or pulling back to 5.0 determines whether equities get relief. Number 4. Poland missile escalation. Any Article 4 invocation rewrites the risk premium on energy, defense, and broad indices.
Quick reminder as we wrap, nothing we said today is financial advice. These are variables, not calls. Let the binary events resolve. Don't be the margin call statistic.
To the trading family watching, protect your capital. These are the days that separate disciplined traders from gamblers. We'll be here tomorrow to unpack PCE and tell you what it means for your book. Cash heavy, heads down, eyes open. We'll see you on the other side.